Hello again and welcome to the section on stocks. We'll start off by talking about the basics on stocks and dividend. Then we'll go through the factors affecting stock prices. Lastly, we have a few tips on the best time to buy stocks. So let's get started. So what is a stock? A stock is a document that proves that you own a piece of a company, right? And holding the stocks or shares in a company makes you a shareholder, and a shareholder is entitled to certain rights depending on the stock. Every company is valued at a certain valuation. The valuation is based on many factors, but usually associated with revenue. The stock price assigns a company's valuation by the stock price, and this valuation is created by the stock market, and it is called market capitalization, or market cap in short. Market cap is a value that grows slowly, okay? So it cannot suddenly change, or it cannot suddenly go up by a lot. It can, however, go down suddenly due to some very serious events like fraud. So why is market cap important? Because the stock price is derived from the market cap, and the formula is given here. You have the market cap divided by the total shares. Every company has the right to issue more shares. They can control how many shares are available for their company. And if the company decides to issue more shares, then their stock price will have to go down because market cap cannot jump overnight. So total share goes up, stock price have to go down. But in general, you don't have to worry too much about new share issuance. It only happens with cash-tight companies. Finally, you should know that all public companies are required by law to report earnings every quarter. All stocks excluding ETF is sorry, all stocks excluding ETF in the stock market are public company stocks. So there are two ways to make money from stocks. The first one is obviously through the stock price, and the second way is through dividend. There's also another way to make money via shorting it, but it is very risky and we do not recommend doing it. So as mentioned, dividend is one way to make money. Some stock will pay dividend, not all of them. Receiving dividend is one of the rights of a shareholder. Dividend is typically paid quarterly after a company's earning report. The dividend is usually a fixed number, and you will be paid dividend for every share you hold. You can typically find the dividend information on Yahoo Finance, which is highlighted by this green circle here. In this situation here, 2.92 is the fixed dividend dollar. So for every share, you are paid $2.92. And 1.35% is the dividend yield. What investors usually care about more is the dividend yield. It is like the interest rate on your bank account. Let's take a look at how the dividend yield is calculated. So here's how you calculate the dividend yield. It is the dividend value per share divided by the share price. To get a better dividend yield, you want to buy the stock when the share price is low. So when the share price goes down, dividend yield goes up. There's one caveat though when you're buying dividend shares when the price is low. You need to make sure the company have enough cash to sustain the dividend. Otherwise, the company can always reduce the dividend paid, which means the dividend value per share. So if this goes down, the dividend yield goes down. And that would make you earn less dividend yield, and you may not be too happy about it. So one last point that we want to point out is that when dividend of X dollar is paid out, the share price will have to drop by X dollars as well. This happens because the shareholders are taking money away from the company. Let's say you take away $100 from the company value will decrease by $100. Therefore, the share price will have to decrease by a proportional amount that the company has taken away from. This has an important consequence. You do not want to buy a share just before its dividend date and then sell the share after you get the dividend. You will not make any money from it. Next, let's talk about the factors that affect stock price. There are many factors that can affect stock prices. In this video, we can only cover a few factors. For other factors, please read the text below to check them out. The most important factor is the net income or EPS growth outlook. Net income is the money that a company makes after expenses and tax. If investors believe the company's net income has room to grow, the stock price will likely go up. Second on the list is revenue growth. Most of the time, revenue growth is the main driver of EPS growth, so they are related. Whenever the revenue of a company is expected to slow, the stock usually goes down. Analyst forecast is another main factor that affects a stock performance. Analysts are people who work for investment-related firms, and their job is to analyze the company performance. And these analysts always update their EPS forecast on a weekly basis. If the EPS forecast becomes weak, the prices goes down. If the forecast is stronger, the stock goes up. You should be careful with their forecasts as they are not always accurate. Another factor that can affect stock price is technical indicators. Due to large amount of technical analysis used in stock investing, technical indicators can move the price. Technical analysis is a deep topic of its own, and it will not be covered in this course. However, we will introduce a tool developed by us to analyze technical indicators and help you predict the stock movement. The stock analysis tool that we have created is called Crystal Ball. Let's visit this website. Let's start by analyzing Apple stocks. Apple stock ticker is AAPL. So let's type it in. On the left, we have the current stock price information. On the right, we can check out its price history. You can look at the 1-day chart, 1-month chart, all the way up to the 5-year chart. Right below the price info, you have the latest news and the latest expert analysis from Seeking Alpha. These items are located here to help you make a better informed decision, especially Seeking Alpha. You can learn a lot from this analyst writing on Seeking Alpha, but you always have to think over the analysis yourself. What is really powerful about Crystal Ball is its ability to provide you with probabilistic forecasts. This eliminates the need for the user to perform technical analysis. Let's take a look at the forecast provided by Crystal Ball for Apple stock. On the top here, it is informing you that it is using the data from August 31st to perform its prediction. Crystal Ball provides various forecasts for different time frames. You can look at the 1 one trading day ahead, all the way up to the 120 trading days ahead forecast. Inside these boxes, you will see the probability it would go up, as well as the typical average return. For example, let's take a look at the 60 trading days later forecast. The probability of the price being higher than its current price after 60 trading days later is around 78.7%. The typical average return is around 10%. To help you find potentially good investment, we have also created a suggestion page based on probabilities. Let's click here to take a look at the page. These suggestions are updated daily to continuously help you to scan the market for opportunities. Hopefully you find this tool useful and you will be able to use it frequently in your investment journey. We'll move to the last part of this section to give you some tips on the best time to buy stocks. If you are a long-term investor, we suggest you to buy stocks only after 2 p.m. The reason is that there are a lot of day traders and computers that trade in the morning. This causes the price to be very volatile. You can easily buy an overpriced stock before 2 p.m. If you buy it after 2 p.m., the prices usually stabilizes and you can avoid buying a stock overvalued or an overvalued stock. Another tip is to avoid buying a stock 2 weeks before or 2 weeks after earnings reports. During these times, the stock prices can be very volatile or misrepresented. It is especially volatile if a company reports any bad results. Wait until volatility is lower to buy the stocks. The last tip is optional. You don't really have to take it seriously. According to Investopedia, Monday is the best day to buy stocks, whereas Friday is the best day to sell stocks. I believe in the Monday theory because of Monday blues. People are probably more emotional during Monday and sell stocks when they hear about a less serious or less positive news. But I'm not so sure about Friday. So this concludes our lesson on the basics of stocks. Please make sure you read the text because there are a lot more information there. Okay, in the next and final lesson of this course, we will talk about exchange traded funds or ETF. They will help you to simplify your investment strategy. I'll see you next video.